Yeah, the S&P 500's cyclically adjusted PE is at 31 times right now. Since 1880, it's averaged 17 times. So equities look very dear. And when we analyse the relationship between US core inflation and US equity PEs, they suggest that current PE should be around half their prevailing levels. So with a 4 to 5% core inflation rate, such as what we see today, we'd normally see PEs around 15 times. The 31 times PE we're observing, cyclically adjusted, really implies that the equity market thinks core inflation is around 2%. So equity investors are clearly not worried about this inflation crisis. When we research what happens to equity returns once the PEs pierce 30 times, we find that the future 10-year returns are absolutely terrible. So most of the time, inflation adjusted equity returns are negative in the decade after the PE punches through 30 times. So we like cash. You can get cash deposits at 5-6%. We like bank senior bonds. They're also paying 5 to 6%. We like bank tier 2, which is paying 6 to 7%. And we also like Aussie bonds in US dollars and euros, which are paying even better yields again. So our key concerns are really around risky debt and illiquid debt. If we look at the high yield bond market, or the riskier part of the bond market, below investment grade, spreads in the US are actually more than 100 basis points less than what you'd normally get through the cycle, which makes no sense, given we're experiencing the worst default cycle since the GFC. So the high yield market's very illiquid, and we don't think spreads that are being reported are truly representative. A little bit like what you're seeing in commercial real estate and cap rates or yields. We're also concerned about what we're seeing in the private credit markets. We're hearing a lot of problems with loans that are not being repaid, funds that are experiencing liquidity issues. We've heard of 12 different funds going to family offices looking for emergency loans to give them liquidity because they've both got outflows combined with borrowers not repaying their loans. Obviously, I don't want to generalise. There are great non-bank lenders and great private credit investors. Historically, we've been very open in saying we really admire and respect groups like Liberty Financial and Metrics. But we remain concerned about the illiquid bond markets where spreads have not widened like we've seen in the liquid investment grade domains. We remain very worried about the impact of this very large default cycle on both high yield debt and a liquid private credit. And we're generally avoiding the REIT sector. Obviously, commercial real estate is in crisis right now. And we're also avoiding the corporate bond sector that tends to be far less liquid and more pro-cyclical. Finally, we are very leery of subordinated ABS and RMBS issued by non-bank lenders that specialise in subprime home loan lending here in Australia. So we are seeing a massive increase in the reported default rates or arrears rates on non-bank subprime home loans that have been securitised here in Australia, where the 30-day arrears rates have increased from circa 1 to 2% towards circa 3 to 4%. I think it's very simple. Just look at the yields. So in cash deposits, we're getting 5 to 6%. Interest rates in government bonds, you're getting incredibly 4 to 5%. I mean, Aussie government bonds are paying you similar yields to what you're getting in commercial real estate. Cash is paying better yields. Indeed, if we look at the All Ordinaries Index, it's only giving you a yield pushed up with franking credits of about 5.7%. So you can get similar returns on some deposits today. And then if we look at the bank market, bank senior ranking bonds are also paying interest rates of 5 to 6% per annum, and bank tier 2 bonds are offering rates of 6 to 7%, even higher again if you look at Aussie banks in US dollars and euros. And then if we shift to the hybrid market, we see all-in yields franked on major bank hybrids that are around 7%. I would say that hybrid spreads, the extra margin you earn above cash, do look a little skinny at around 2.5% above the bank bill swap rate. Historically, that's quite small relative to the yields that hybrids would pay compared to tier 2 bonds and senior bonds. Normally the hybrid market gives us 2 times the spread that we'd get on higher ranking and safer major bank tier 2 bonds. Today, hybrids are paying about 1.5 times the spread on tier 2. Yeah, liquidity is really a condition precedent or a sine qua non for us. So, our higher octane strategies are turning over between 8 and 20 times a year. So to turn over the book that actively, you can only invest in liquid assets. So we were shorting Credit Suisse senior bonds last year, and most of the rest of the market was chasing yield. In fact, many Australian investors had even loaded up on Credit Suisse hybrids that were wiped out. We had a blanket ban on long exposures to Credit Suisse all the way back in May 2021. So we're very good at identifying the bonds that will be liquid in all markets. And it's pretty simple. They've got to be very safe. So generally, you're talking about government bonds or government guaranteed issuers or implicitly guaranteed issuers. And that's what we tend to focus on. We're typically trading 300 to 400 million a day. And since the start of last year, we've turned over about $132 billion of bonds. Crucially, we average negative transaction costs. What that means is we're not chewing up returns through this active trading. Rather than paying away the bid-offer spread, Coolabah actually systematically earns the bid-offer spread. And there's no brokerage or commission in the OTC bond market.